Let's start. So good evening, everyone, and welcome to the new followers. There are many today. There is traction in this portfolio management during crisis. So this is number 5. We started 5 weeks ago, and the whole idea is trying to help you in those volatile times for the market. So quickly for the newcomers, I have 20 years experience as a hedge fund manager and prop trader. And I've been mentoring people since 2014. And you can find more information about mentoring program and the video series on gregoiredupont.com. So let's start with today what we're going to be looking at. So we'll be looking at, as usual, at the situation across asset classes. We're going to be looking at the different charts. Then we're going to be looking at the breakouts that happened this week on Amazon, Netflix, S&P, different stuff inside the S&P. Auction expiry, we're going to be looking at retail sales for a bit of macro. We're going to be doing the banking sector in Europe and in the US. We're going to be covering the oil market. And we're going to be doing as well the earnings season. Then it's going to be the Q&A session. So quickly, last week when we look at the S&P 500, we look at the Fed, we look at oil and the earnings season as well. And make no mistake, all those topics are still very valid. But today, I want to be looking at some other stuff. We looked as well at implied volatility versus realized volatility. As you probably saw, for those of you who have been trading the market, we are more or less at the same level on the S&P 500. So we are now at 2790 on the futures, which is exactly the same as last Thursday. But in between, the market has only been moving 2 to 3%. So the realized volatility on the S&P 500 has been coming down massively. But inside the S&P 500, there is a lot of dispersion. Dispersion means that if you look across these 11 sectors of the S&P, some have been doing very well and some have been doing very badly. So one of the sectors that has been doing very well is the technology sector, same for the healthcare. And on the contrary, the sectors that have been struggling, one of the sectors that has been really, really struggling is the financials. So we're going to be looking at this because we had the earnings from many US big banks, and that's explained a lot about the underperformance. But what we can say from last week is actually the realized volatility has been coming down. If you look at a day like today, the intraday move is around 30 to 40 points, which is 1.5% roughly, which is very small from what we used to have even 2 weeks ago. So realized volatility is coming down, which is something to keep in mind in terms of building a portfolio. The S&P again and across asset classes, as we will see, there has been risk appetite. It feels like there is a bit of a resistance that has been ongoing since the last week. But let's look at I mean, we all know what the central banks have been doing, and this is the charts that I put last week, but now it's a new one, obviously, that is updated, which is the Fed balance sheet on the left-hand side, and the ECB balance sheet. So as you can see, 6 trillion on the left and 5 trillion plus on the right. So if you think that the euro is 110 for the dollar, you have very similar balance sheet. For those of you and probably 95% of people that are struggling between fundamentals and the price action, I mean, it's easy to see here when you look at the size of or the increase of the balance sheet that is helping massively the risk appetite. So let's jump into Google Chrome and see across asset classes. So as always, I start with the S&P because this is where is the noise here and where I think most of you are interested. So we close at 2790. So this is the level. So last week we looked at the 2740. We pushed higher to the 2840. I think that the question now is, are we going to go, is the 2840 some kind of resistance? And if you look at this, could that be a head and shoulder and we're going to go lower? What we see is at least the volatility is coming lower and the volume is drying a bit. So all is about the earnings season and what the earnings season is going to tell us. If you look at the NASDAQ, actually it feels more like the next resistance is around this 8950. So that's the resistance that we have here, the support. If you look at Fibonacci, I can't say much around Fibonacci, so it's not really working similar to what we looked at last week. Quickly, the banks. So this is something that we're going to be talking today. So here you get the stock 600 for Europe. And that's something that is interesting because it is extremely weak. So versus the overall market, the banks have been very weak. Again, this is something that we'll be covering. So LQD, this is something as well that we covered many times now, which is the ETF for the investment grade. And this is where, since the 23rd of April, of March, the Fed has been buying assets in the market and has been buying bond and has been saying, you know, we are in a position to be buying ETF. So it's almost at all-time high, meaning that when you're looking at the S&P, you need to be careful because if everything goes back to where it was before, the S&P has let's say 10 to 15% at least to go up. But this is LQD, MBB, which is for the mortgage-backed security, back to square one. If you look at municipalities, it's almost at square one. But if you look actually at the high yield ETF, it is not recovering to where it was before. So it's at 20% below where it was before. If we take the HYG, I mean, it's at 10%. So there is still a part of credit, there is still a part of the market that is suffering, which is the high yield. And that's something that as well we're going to cover when we'll be looking at the banks. So that's for the credit market. At the same time, the US 10 years is around 60 bips. So we need to monitor as well where if the US 10 years is going to go lower than 60 bips, 61 bips tonight. This is, we have been testing the 60 bips. So the credit market has been pretty weak versus the equity market. So over the last week or so, there is clearly a slowdown in the risk appetite on the risk on. So let's look now at commodities. So we're going to be covering oil at the end of this call. That's something that I've been massively covering over the last five sessions. So which product will you use to position in oil for 6 to 12 months time for the contango reason already discussed? So that's one of the questions. Don't use USO, which is the ETF, because it's going to get killed with the whole of the futures. So if you get a book big enough, you should probably go to the futures. Otherwise, it's not that easy to be playing to being oil. If you play USO, that will be very short term. On the gold, as I told you, I'm not a big fan, but I'm not going to go against it, and I understand the rationale of going along the gold. So let's go, instead of being on 1 hour, let's go into 1 day. So I think what is interesting for the gold fan, and if you want to do a bit of chart. So today there's going to be a lot of charts, there's going to be a lot of visual, because this is a lot about price action in this market. So if you look at this chart, and some of you will know what is happening, this is a cup and handle, meaning that if it breaks this 1780, 1800, there is a good chance that it's going to go much higher. Okay, so technically you can see that this is a strong price action, which makes complete sense, because you know it's a risk off, and people are trying to find where to put their money and to let's say to hedge themselves about what is ongoing with the central banks. We're not going to do much of the other commodities. There is a question about what is CL. CL is the future for the light crude oil future. Okay, so you can look at the different contracts. If you go on tradingview.com, which I'm using here, you type CL, you can do the same on investing, and you're going to have the different contracts. So this is the one really that is trading. This is the benchmark. Let's look quickly now at the currencies. As we discussed before, the Fed has been extremely good with these FX swaps at mitigating the shortage of dollar. Okay, if we look at the euro dollar, again, technically it feels like something could be broken and that euro could be lower. And even if you look at the emerging market kind of currencies, I think now there is a risk of a second wave of risk off in the currencies, and I'll be extremely careful. I think the dollar could get stronger here. So this is something to check, and maybe the Fed will have to do more. If you think, and this is something that we discussed last week, if you think especially about emerging markets, so emerging markets have been printing bonds in dollar, emitting bonds in dollar over the last 10 years. And I think now, because of the slowdown and their currencies that have been really struggling, there is clearly a risk that for those currencies to weaken even more. And if you look at the Turkish lira today, it was weak again. But you should keep your eyes on those currencies that could be moving real time, because the pressure is for them, and it's going to be there at least for the next 12 to 18 months. So look at currencies and emerging market. Then the other charts we will be looking in the next slide. So let's go back into the PowerPoint. So PowerPoint central banks. So I would like to start first with some breakouts that we had this week. We'd like to start with Amazon. So as I said when we started the call, is the S&P is more or less flattish on the week. But if you have been trading, there has been massive dispersion between the winners and the losers. And one of the biggest winners as a sector has been the XLK. So last Monday, I was checking the open and trading the open, and one of my ex-mentees, was discussing with me, and I said, okay, look at Amazon at 2050, and so he bought at 2050 because it was breaking out, and then he made probably 3%. He was happy, which was good. Then now today it went to 24.50, and it closed at around at 24.8. So we had a massive breakout on Amazon. The stock is up 400 points in 4 sessions, which is 15%. Amazon, we get the earnings coming next Thursday after the close. But what I would like for you to understand what's ongoing is the same as January and February. So January and February, many tech stocks were driven by options. So I would love today to be looking quickly at options and for you to better understand what is ongoing with options. So the way to do it is you go on the cboe.com website, and you're going to have the quote on the option. So every week you get the expiry for the options on the Friday. So this is the biggest expiry of the week, which is on Friday. And you have the volume. So if we look at Amazon, so that was today, and let's try to refresh that. So that's the expiry for today. So you can see here that is the volume that was traded on Amazon. So we are talking 5.5 million shares. Okay, and now we're going to be scrolling down the option chain, and we're going to be looking at the open interest and the volume that have been trading around 2,400. As you can see here at 2,400, this is this one, we had 24,000 options, meaning 2.4 million shares worth that were trading, and at 2,500 you got 18,000. So even if you had a call spread And that tells you that roughly half of the volume is traded through options. So this is clearly a market, not a market, but those stocks are being driven by options. So Amazon when Amazon broke out, there was a massive volume. I think it was roughly something like 30,000 calls. So what I suggest you to do is to be following those stocks and how the volume is and the open interest on a weekly basis. So that's the same for Netflix. That's the same for Microsoft. And why you want to do so? Because people, especially in the US, because they don't have the same leverage as we have in Europe, the only way to get access to Amazon or Microsoft in a good size is they go through options. So many retail traders, and we have seen many new participants in this market from retail, are buying and selling, and most of the time here it's 80 to 90% of the time long through call options. And this is why, and then people have to chase the stock because the market maker have to hedge that delta. So a lot is explained by the option market. So again, go on cboe.com, get familiar with expiry, get familiar where there is a big volume, because that could tell you a lot about the next move. So if we go back now into here, Amazon. So Amazon, again, for tomorrow, there is a lot of volume between 2,400 and 2,500. The earnings are, I think, are Thursday after the close. Massive move. You should be checking the volume. You should be checking the open interest for next Friday expiry. Similar to Netflix. Netflix, we went from 387 to 450 and we closed at 439. This is the same story. But what is interesting is options, and something as well that you should be doing, and which worked very well in January, February, is looking at breakout. So breakout more or less is, if you look at a chart like this one of Netflix. Okay, so if I can use this one, no, how can I do that? Sorry for that. It's gonna come. Pen. No, doesn't want me to do. But if you okay, so if you see here, so you get a top, and a top, and a top, and meaning what you're going to try to be doing through your filtering is finding all the stocks from your universe that are close to this top, and that could be doing a breakout, meaning going higher and breaking this resistance. And that is a combination, obviously, of the price going higher than the whole time high or the 52-week high in big volume. Someone mentioned Roku. That's the same. Roku, yes, is breaking higher. So you get the market that is driven by those names. So I think what is interesting when we look, if I manage to do it, okay. So here, what I want you to understand as well is, and so the chart on the left-hand side is a chart from Goldman Sachs, and on the right-hand side, this is something that I built. So the S&P is more and more driven by a few names. So if we look at the top 5 names in the S&P, they are making 20% of the S&P. So if we look at the chart here, you can see, so finally this pen is working. We went from 12% in 2017 to 20% now, mostly because of the biggest rally that we had on the XLK. And meaning that if we want to understand the internals of the S&P, we need obviously to understand how these 20% are gonna move. So Microsoft today is up another 3%. Amazon is up another 3%. Google is a bit dodgy, and Facebook not as strong. But you have a lot of those big names and a lot of tech that are going higher. So tech is outperforming the overall market. And here I want to go into the next slide, which is looking at the Russell 2000 growth versus the Russell 2000 value. And as you can see here, we are making new highs. So the story is people are trying to chase the same names, and at the same time investors want to buy growth, okay? And the idea so far is technology, XLK growth is gonna deliver, okay, because of their business model. I think we're gonna have a start of an answer from next week, when names like Netflix, Amazon. The story obviously of Netflix and Amazon is it's supposed to be a very good time for them to benefit from the coronavirus crisis. Both Netflix and Amazon, we're going to see across the sector how it's going to do. So that's the Russell 2000 growth versus the Russell 2000 value. As you can see, this is the chart, which is accelerating. If we do the growth versus the Russell 2000, you can see that from 2017 there has been a massive move up. So that's something when we do asset allocation, when we look at the overall market, and more importantly, understanding the internals of the market, what is moving in the market. Because if you tell me, oh, the S&P is flat on the week, actually, I'm going to answer to you that many names like Netflix, Microsoft, Amazon, I think the Nasdaq is flat on the year, are making new highs for those, for Amazon, for Netflix. And again, they're going to be coming with their numbers next week. Now let's do a bit of macro analysis. I just want to be doing one which I think was telling a lot about what is happening. I'm not going to bother about looking at 50 macro numbers because the world is, we know what the world is going through. But just quickly looking at a bit of macro with yesterday's retail sales. So here we got a screenshot of one of the Excel spreadsheets from the 4x4 video series. And I want to be looking at the core retail sales, so meaning ex auto and gas. So we are down 3%. Which is bad, but could be worse. But actually, if you think about two things, which is first, the food and beverage is up 25%. So that means here you get roughly 17 billion up versus the last month, which is due to people stocking food and beverage. So that's the factor that has been helping. We can assume that it's going to come down. And the second factor that was helping is that is a number in March. But the US started to be in lockdown probably around mid-March. So we should expect the next retail sales to be even worse than that. But that tells you about we all know, but how deep this slowdown is, we are not talking slowdown, sorry, this recession could be, and that's a big tell about what's going to happen in the next 2 to 3 months. Again, we had the confirmation with some other numbers, with local PMI and some others. Today we got the housing market. I think with the housing market, and especially the permits, we need to be careful because these new permits is not as relevant that it was before 10 and 15 years ago. So it's not an as good leading indicator as it was before. And more importantly, we know that the credit market and we know that the banks are suffering. So that means the financing for housing is going to be very, very bad in the next 12 to 18 months, despite yields being low. So now, moving to macro, I want to go back into price action. And again, this is something that I covered before, and I want to move a bit from the US, and I want to move into Europe and be looking at the European banks. So here we get the stock 600 for banks that is close to making new lows. So so you can see here, despite the market, despite the stock 600, despite the Euro Stoxx 50, meaning the European stocks bouncing by 20%, we are only 5% from the lows on the European banks. To me, I mean, maybe I'm a bit too old school, but I think an economy, the whole system cannot recover if the banks are not doing well. And to me, if the banks keep on having a bad price action, I think any bounce is really just a bounce, and that means the underlying economy is bad. And one of the reasons that obviously we can be looking at for the European banks is all the spread between the government bonds. Here we have a look at the Italian 10 years versus the German 10 years, which is the BTPs versus the Bund. So you can see that, so here you get the spike, which is the panic. Here you have the ECB intervention saying, you know, we're going to be here, we're going to be standing ready to be buying bonds. So the BTP were doing better, but since then we have a bounce. So to see the market and to see the spread between the Bund and the BTPs going up by 70 bips in 10 days, when the ECB is actively buying, is a bit scary. So either the ECB moves back very quickly, or, you know, the European governments do something in common, but that tells you that there is still a lot of stress in the system, despite volatility coming down. So if you remember correctly, and that was one of the questions, I think it was a couple of weeks ago, someone in Europe asked me, you know, what do you think about the short selling ban on European stocks? And I think it was yesterday, they decided for 5 markets in Europe to extend those short ban sales. I think it's in France, for instance, and other markets for another month. And in Italy, it's going up until the 18th of June 2020. But if you look at the price action of the French banks, so here you get the Stoxx 600 versus Société Générale. Okay, so Société Générale, which is a French bank versus the sector. As you can see, despite the short ban, there is a massive underperformance of the sector. And you could do exactly the same with the Stoxx 600 versus Intesa versus Italian bank versus Unicredito. It doesn't matter. Even if the regulator is banning the short sale, the price action is telling you this is not going well. And I'm saying that with Société Générale. So you have the chart here, which is since 1993. So here you get the lows in 2011, and we are lower than that. So me, as a trader here, I listen to the price action. If the banks are making new lows or close to making new lows, it tells me that the underlying system, because our economies rely massively on the banks. So yes, you can tell me that the risk is switching from the banks to the central bank, but still, if the banks are not functioning well, you're not going to have a loan, you're not going to be able to carry any business. And that's for Europe. So I already can hear people telling me, you know, this is only for the French banks. But, and again, if we look at the OAT, which is the French 10 years versus the German 10 years, we had a spike because obviously there is stress in the system, but that's the same if we look at the US, okay? So in the US, here we look at KBE, which is the ETF for the US banks, versus the SPY. So since the start of the year, we have been making new lows. We broke down, and again, the weaknesses of banks is across the world. Yes, I understand that there is no yield, that the yield curve is going to be flat for long, and the banks are not making money. But more importantly, that tells me that there is a deterioration in the quality of the assets. And why I'm saying that is probably some of you, after I told you, I recommended you to be listening to JP Morgan earnings call that was on Tuesday. If you are not listening to the earnings call, at least, you know, reading some of the transcript that they were making, But JP Morgan here said had a provision for credit losses of 8.3 billion. And here they were mentioning all the sectors that were impacted. So oil and gas we knew because JP Morgan has a lot of exposure to this sector. There is real estate, obviously that makes sense, consumer and retail industries. So what Jamie Dimon told us on Tuesday, so Jamie Dimon is like, you know, is the king of the king for the banks. He's telling you on the first day, is the first releasing the earnings, is saying, look, we're going to be suffering. The credit market is deteriorating, and I think it's going to be deteriorating even more. Okay, and that was on Tuesday. Whereas at the same time, Amazon, Netflix were all breaking out. So let's look now at the price action of JP Morgan. And I kind of tweeted many, many times on Tuesday to make people understand what the banks were saying. So JP Morgan opened around 101. Very quickly, it went flat on the day. Then it came down. So you have this. Then another day came down, up. Another day came down. So on the week, it's down $10 or 10% or plus. So this is the price action of the banks for this week. And you can do the same with Wells Fargo. You can do the same with Bank of America, Citigroup. What is it telling me for me? As a portfolio manager, as a trader, it's telling me that the price action is disgusting. And as a portfolio manager who wants to build a book, I'm saying, I know that there is massive risk. And there is massive risk. Why? Because if there is stress in the credit market, if the leader in the bank, which is JP Morgan, is telling me that they are putting 8-9 billion provision on the quarter, and since then there has been deterioration in the real economy, it's not going to get better. And on top of that, I know that XLF, KBE, whatever, they are not going to be in a position to be using share buyback. So if you think about it, you know, banks like JP Morgan, Bank of America, Wells Fargo were expecting to be making between 20 and 40 billion share buybacks. This is completely off. They are not going to do that at least until the end of the year. And at the same time, I don't know, maybe some of you saw that, I can't remember which Fed governor said this, I think it was today, that the bank should put aside probably around 200 billion because of the crisis coming. And when we say 200 billion, it's because of the leverage. So there is clearly a dichotomy between XLK and hoo-ha and huge expectations, and the real economy, the banks that are really, there is a deterioration. Let's look now at the oil market. So I've spent many sessions discussing the oil market, and I had people, again, during the sessions telling me, you know, this is probably the lows, and it's about trying. Look, the story about oil is a story about supply and demand is dead. Okay, so now oil is trading at 1966, so below 20s. It made new lows yesterday. There was an interesting report yesterday from the IEA organization saying that the global oil demand is expected to fall by a record 9.3 million barrels per day year on year in 2020. And in April, as we discussed, yes, that was Neil Kashkari. Thank you, Pierre. Exactly, that was the Minneapolis Fed president that said you need to put aside 200 billion. But coming back on oil, so estimated to be 29 million barrels down. And as I said last week, it's going to be 20 to 30 billion. So even if the OPEC is doing 19 billion, it's not going to be enough. And again, I got nothing against the OPEC, but we know it's going to be almost impossible for them to be 19 million. So maybe it's going to be 10, 15, because if your revenues are down massively, some of their participants are not going to clearly going to respect those new quotas. So what you're going to have is still a massive imbalance between supply and demand. And the tens now that we are in tens, we could go lower, depending for how long we're going to be going into a total lockdown. There is, I think it's at 6 p.m. Eastern time, the Trump administration that's going to talk about, the possibility of reopening the economy. Here, there is a massive imbalance between what the Trump administration wants to say and actually the local governors are saying. If you think, so the New York governor said, nothing is going to happen until mid-May. So that gives you another month, and that means it's going to restart slowly. So that means it's going to have a huge impact still on oil and demand, so let's look at the next chart, because again, there is a lot of chart today, and I hope there are not too many, but I like this one, which is the oil demand in million barrels variation year on year. So normally you should expect, and that's the green here, you should expect the barrels to be up 1 million, roughly 1% year on year. The only time that we had a drop was really in 2008, 2009. So here you get the chart for this year. This what is expected. We are talking 9 to 10 million. And that gives you the oil demand in million barrel chart since 1990. So you can see this massive drop. Obviously, you can do many charts around oil consumption, retail sales coming down. But for oil, that was an easy an easy price action telling you that the real economy is really suffering, and the squeeze or the rally that we had so far has nothing to do with fundamental. It's really about central banks. So looking at the oil structure, we've done that a couple of times already. So here for the newcomers, just to explain to you, is looking at the different contracts for the CL. And if we look at the months of May, the months of June, the months of July, you'll have different price. And what we say here is the oil price is in contango. And what you see here is it's flattening from July onwards, roughly. Okay, so here it's pretty flat, but here it's massively steep. So until mid-July, we should not expect the oil market to recover, meaning that if it's not going to recover until mid-July, probably the economy is going to stay where it is for the next couple of months. Okay, so that gives you literally a quarter of big slowdown. So finally, I want to jump into the earnings season. I mean, we started to discuss that. I strongly advise you to be looking at JP Morgan on Tuesday, because I think it's very interesting about the real state of the US economy. So for those of you who don't know what to be looking at, you can go on Benzinga or on Earnings Whispers. And what I strongly advise you to be doing is putting in your calendar for every day, what are the companies that are releasing their earnings? Why? Because you want to know what are the markets leaders, the sector leaders, the industry leaders, when they are releasing their earnings. So if we look at Monday, we're going to have IBM, we're going to have Steel Dynamics, we're going to have Halliburton. On Tuesday, we're going to have Chipotle, we're going to have Interactive Broker, Netflix, Texas Instruments, Emerson, Coca-Cola, SAP, and Philip Morris. And as I said, on Thursdays, there is Amazon. So you need to put in your calendar when are those companies doing, because as I try to explain to you today with many charts, it's a lot about price action and understanding what is underperforming, what is outperforming in the market, because that tells you a lot. So I understand the frustration of many of you, and me included, of sometimes not being in a position to build in the portfolio. The thing is now is the volatility is coming down, so that means we probably have more opportunities to build a portfolio. But I think what is key is to be listening to the market. If the market is telling you there's a lot of volatility and it's a trader market, you have to respect that. And it's not, the frustration is the following. When we go from 3,300 to 2,300, everyone is going to tell you, oh, I should have been making this 40%. When you go from 2,300 to 2,800, I should have been long. You need to have signals. If you don't have anything, don't do anything, and there's no, and that is fine. So that's something that I try to explain during the mentoring program. So there are many mentees today, and I hope they are doing fine, and they are respecting the process, and they are respecting their own risk management. The 4x4 video series for the newcomers, this is something that I built over the last couple of years. I spent 3 to 6 months last year, and the whole idea was to help trying retail traders that have been struggling with the process or so-called process. Starting with a good macro understanding with the components and the drivers, and more importantly, is trying to have a good asset allocation versus the economic cycle. And I think here it is extremely important to understand what is the economic cycle telling you and where to put your money, and it's going to be fundamental in the next 18 months. For those of you who have been trading, you have been understanding the importance as well of expected returns versus realized returns, which is implied volatility versus historical volatility. The macro analysis, I really want you during the mentoring and during the 4x4 videos and during the sessions that we are doing together, I'm trying to show you how to build your infrastructure, okay? And that's something that takes time. You need to have a process, you need to have those websites. So in the 4x4, I offer 50 spreadsheets trying to help you to do it. Then the next step is ID generation. So ID generation, as you can see today, I talk a bit of macro, but the macro, we know that the macro is really bad. The thing is, if you stuck with the macro and you kind of leading indicator, that's not going to be enough. So you need to do more. You need to be doing, you need to do special situation. You need to do active trading. You need to be looking at the price action. You need to think about bottom up. So why? Because you want to be making money over time and you want to be flexible in your ID generation. What is key? And here, this is a frustration that we all gonna have. When the market is moving like this, we're gonna tell, oh, I'm not making money, everyone is making money. If you generate one trade per week, meaning 52 trades per year, and you get 1/3 winners, 1/3 losers, and 1/3 flat, and your winners are twice your losers, you're going to be up 15 to 20%. So you can put that on an Excel spreadsheet, but those are real numbers. So when we have done the macro, bottom up, and all of this, I spend a lot of time with quantitative and fundamental analysis. Why? Because if you don't understand the macro and you don't understand the fundamental analysis of a company, you're never going to be making money. And here, it's not, again, something that I've said many, many times. It's not for you to be the best analyst. And I understand that we all want to be making sometimes money quickly. And we think, okay, there are easiest way to do it. But I don't think they are. I think it's a lot of work, okay? It's a lot of work. But when you have your infrastructure and you have a process, when you have ticked many, many boxes, you're going to be feeling much more confident. And this is why you're going to be jumping into your watch list. And then the play, as always, is technical analysis, price action. We spend a lot of time today on this. The risk management, again, you probably know my style now. I'm very boring, old school. Why? Because risk management is key. And then, you know, how, looking at your P&L, how we're making money. So this is more or less what we have for today. We get 10 minutes or more for Q&A. Let me go through the Q&A. So let's start with the question. Will you still be using ISM and NMI to filter for IDs now? As you can see, ISM and NMI now, despite being leading indicators, have been lagging indicators because we knew that the whole world was into recession. So when we look at ISM and those leading indicators, what I find extremely powerful is the sectors. Okay, so looking at the sectors are going to tell you where to allocate some of your money, but you always, I think one of the catches, if you only use ISM and say, okay, I'm going to use ISM, you take your 36 sectors overall, and you're going to be taking 3 good sectors and 3 bad sectors. So after 2 minutes, you're going to decide to be putting aside 80% of your universe. And I think this is completely wrong. So what you need to be doing, and for 4x4 videos, I'm repeating myself 50 times, is ISM is part of the process, but you need to be thinking about 2 other things, which are market conditions and the other macro conditions. So that means global themes, what the other macro things are telling you. Okay. Do you really use technical analysis on the front line? You don't use mathematical models such as Black-Scholes for prediction. So if we look at Black-Scholes implied volatility is what the market is pricing in terms of implied volatility. Okay, so that's what market participants are telling you. Then you make a decision. Is the implied volatility too low or too high? I give you an example. If you think about mid-February, when the implied volatility was at 15, I took the decision that the implied volatility was too low. Okay, then I probably sold at 30% implied volatility. Then it went to 90%. So when you do 15-30%, you think, okay, I'm good. But when it went to 90%, I was like, okay, actually I'm rubbish. And that's what you do. And I've done a mentoring program when my mentee went long implied volatility at 50. And I was like, are you really sure? And it went to 90. It went very well. And then he unfortunately, because of risk management that could have been better, he gave a bit back of his money. But you make a decision based on your process, where you think is your risk reward. Do you cover futures, and how to understand them on the 4x4? So for the futures, the thing is, my assumptions is most people that will come into the 4x4 video series will be retail traders. Okay, so if we think about the S&P futures, we are talking a multiple of 50. Okay, so a multiple of 50, roughly that's $130,000–150,000 for one contract. I don't think that there are many people that will come to me first with $100,000 portfolio or 150 and will be hedging their whole book. So future, I'm fine doing it. I trade futures these days when I trade oil because it's 2025. Otherwise, for most retail traders, as there are many good ETFs in the US, I will be doing ETFs. So if you think about the SPY, and if you want to have other positions, you can go through options. So what I'm trying to do is having both the ETF, which is similar to the futures, and the options if you want to structure the trade in a different way. Hello, I'm using top-down fundamental analysis to build my watch list. How do you manage your watch list with the macro and sector indicators? Again, I like top-down. I think you should be doing more than top-down only. And this is what I'm trying to help in the 4x4. I'm pretty sure that these days with your top-down, you're going to be struggling. Okay, if you only do top-down these days, you get this massive rally in your face. You get ID generation that is hard to do. So you need to have different ways of doing your ID generation, which is bottom-up, which is active trading, which is a special situation. Those are the 4 pillars of the 4x4 video series. And again, it is extremely easy for me to tell you that, guys, and say, look, you should be doing this. And this, in reality, this is much harder. But if from day one you say, I only got one strategy, you could be dead or let's say, wasting P&L for the next 12 months. Do you think Netflix earnings are going to be up next week? I have no idea. This is not what I do. I'm not betting on earnings. Playing earnings are pure casino. I think what I'm interested is if I look at the implied volatility of the Netflix, then I can make a decision. But implied volatility is pretty high. Implied volatility is going to be even higher because of the earnings. And then I'm going to be looking at the price action of how Netflix is going to be doing, because that's going to tell me a lot about how the market could be doing. So in the meantime, the S&P is squeezing a bit. Second part of the Madoff story, that will come one of these days. Given current market conditions, individual stock gap risk, highly priced volatility for options, do you think sector ETF spread trade is a good choice, is a good way of playing current market conditions? Example, biotech, ETF, regional banks. So yes, I hear you on the high volatility, which makes the hedging much harder, especially for the options. What I think is important, and this is something that I repeat probably 50 times when you do the mentoring, is don't force the trade. And when you have a pair trade, you get two legs, okay? And what you're going to have very often, people will say, okay, I want to be long this one and short this one, and they're going to be mitigating the sector risk, the market risk, and the industry risk. But the reality very often, because you don't do well the research, is it's not going to be a good match. So you're better off thinking, okay, where is my conviction? When you think about a trade, where is my conviction and what is the risk? What is my downside? Okay, what is the worst case scenario? So if you think about building long short here at the moment, we know that the volatility on both legs are going to be extremely big, okay? And you want to make sure that we are talking the same industries, because if you are taking even different industries, it can be literally against you big time. How to do long pair trade sectors? I think long short sectors, like as you mentioning, XLK versus XLF or another one. I'm not saying that you should do that. Make no mistake. It's just that I think it's probably easier these days, obviously, because you are not facing the company-specific risk and the gap of it. Still, as you can see, there is huge dispersion between sectors. So if we do XLK versus XLF, we are talking of 10%, 15% moving on a weekly basis. The thing is, can I put those positions on my book and sustain the possibility of 10% in my face after 1 week? My risk management is I don't want to be having a hard stop loss higher than 7 to 10%. Okay, so after 7-10%, I want to get out of the position. If my hard stop loss is 7-10%, and I have the asset or the position going 10% after 1 week, I know that either I'm going to be trading 1 to 2 weeks, or I will have to reduce the size of the position if I want to keep it for longer. But here, it's either position or it's not for me. What else? Do you think the UK stock market will fail to regain its all-time high with Brexit and damage due to COVID? UK stock market, Douglas, I have to be extremely honest. I'm always struggling with the UK market, not only because I'm French, but because I think this is a hard market to trade. For me, European ones, there are much more opportunities. And what I don't like in the UK market is there is a lot of insiders kind of news where if you're not trading the big names, you'll be the last one to know what's ongoing. And in terms of regaining its all-time high, if you think about the all-time high, only the US are very close. The rest, it's either you think that the economies are going to recover, so that's normal, the earnings are going to recover and the assets will go up, or even if the economies are not recovering because of central banks are pumping so much money into the system, there's going to be asset inflation. That, I don't know. I think that the struggle here is a question of implied volatility and how you can play upside or downside. Is it a good idea to go into the defensive equity sectors now, health and utilities? If you look about health, so the health, which is XLV, has been outperforming massively. So I had the same questions, I think it was on Tuesday morning with one of my mentees. If you think about the health XLV, upside, there is some upside, but what is the downside? Imagine that for a reason, there is a Democrat that is winning the election. And this Democrat is saying, because we pumped so much money into the system, we need healthcare for all Americans to come down massively. And then suddenly XLV is going to go down 30 to 50%. So think about, I mean, it depends on your time frame. Obviously, XLV is benefiting. You do have the price action like XLK is in your favor. So if you want to go long, it's going your way, which is fine. But still, let's put it that way. I think your visibility it works as long as you are in the money. And when you start to be close to your stop loss, you need to put your conviction aside. Okay, so you don't want to be stubborn and thinking, okay, this is a strong conviction, and changing your view very quickly. What else? What else do we have? Oh, do you recommend calendar call put spread strategy for this volatility market? The thing is, if you knew me a bit more, you will know that I'm not very smart. So I like to do very simple strategy. I think when people are telling you to do call put spread strategy and you're a retail trader, I think it's a fake. I think really it's a fake, because even professionals are struggling. You need big size. And as I said I think it was a couple of webinars ago, is for options traders, you need a big book. You need to see the flow. When options, doing the basics is easy. It's super easy. When you start to put structured trades, you need to be smarter than usual. Okay. And the reality, I feel like, people want to go into that direction, because I understand why. Because in the US, you want to be doing options. Otherwise, there's not much you can do if you get not much money. What people are losing it here is implied volatility is very attractive, because you think, oh, when the VIX goes to 15 to 90%, you will have been making your money. But trust me, implied volatility is a tough beast. And when I say that is, if I look at all the portfolio managers, you need to understand implied volatility. You need to, in a sense, smell it before putting options position. So my advice is start with simple strategy. And if you want to do some options, when I do the mentoring, we do a lot of options. Do we do funny strategies? No, we don't, because I hate that. And that's my strongest conviction. And that worked over the years. TradeStation, I'm afraid I don't know TradeStation very well. Interactive Broker, I know it. It's a good platform. I like it. What else? When managing winners, when you're up 25% below your soft target, it takes a 10% drop. What should we be doing? So first thing first, I start with your downside, which is your stop loss. You can't play with your stop loss. You respect your stop loss. Okay, 7-10%. What about the target? So target, you have, let's say, two different schools. So you get the schools that is up 20%. And they're going to tell you, I'm a big guy, and when I'm up 20%, my position is going to be go bigger by 50% on 100%. And then you get the other school that is telling you, what about I take some profit, or I'm using a trailing stop? Again, it really, for me, depends on many factors. If you're not making money, and if you're not be making money, and suddenly there's a trade where you make 25% where you were expecting to be making 10%, you should be taking profit. When you're not making money and you get something that puts you flat, then you need to be trading that position. And when you know that there is going to be volatility, you know that it could come back in your face. So there is no rule to that. What I think is important is having a trailing stop. Okay, so if you're up 20, 25%, you say, okay, at 15%, I'm going to take profit. From my experience, each time I was way positive on a position and I ended up being flat or negatives, that destroyed part of my process for the next few sessions or months. Because I thought, why did I do that? I was up, I didn't use a trailing stop. And you always need to be thinking, okay, I'm up 25, but what about it goes back flat? How I'm going to be reacting? Trust me, it is a different look. I know again about people, pretending that they are putting 50% more and being the big guys, and it's just not true. It's just not true. I mean, I know that why people are buying it. I know the story. It doesn't work like this. It's not that easy. You need to have trailing stop. You need to have a risk management. What else? Do we have anything else? Maybe that was the last. Then I think that's it for today then. What else? No, I'm checking right now. Yeah, I think this is it. Okay, thank you very much, all of you, for joining. I think it helped. If I missed some of the question, please send me an email to contact@gregoiredupont.com. Go on the website if you have questions about the mentoring program, the 4x4 video series. Let me know. 4x4 video series, I got a very good feedback since October. I think people are very happy about the process. So if I can help you and answering your questions, I'm happy to answer it through a Skype call or through email. Thank you very much for joining, and be safe, and talk to you soon.